Asian markets are rising after the largest Fed rate hike since 1994, with European markets set to join the global rally later on today. The Federal Reserve raised benchmark interest rates 75 basis points on Wednesday in a move that equates to the most aggressive hike in 29 years. This is that it is scrambling to contain a disruptive surge in inflation, which is proving much more difficult to tame than expected. The Nikkei in Japan is in the green territory this morning, and so is Kospi in South Korea. But the Shanghai Composite in China is hovering just below the flat line. And despite the big increase at this month's meeting, the Fed's chair, Jerome Powell, has indicated that he is not expecting moves of this size for at least the rest of the year. Take a listen.
And I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can.
For more on this now, let's go to David Madden, who is Equiti Capital Market Analyst in London. David, thank you for being with us this morning. First of all, what is this excitement on markets, really? We've seen a sell-off in the past few days, and now this hike, and what's this rally saying?
Well, we have seen a lot of volatility in stock markets in the past 12 to 18 hours. Initially, we saw a bit of downward pressure on the Dow Jones last night. Things managed to turn it around, but now the kind of more fears about actually a recession have kind of set in. We're seeing quite aggressive losses here in Europe. Things are also looking fairly negative once again for the US index futures, suggesting things will open lower when cash trading begins over New York. And this excitement really is all about the fact that interest rates are being risen at a time when the economy is slowing. Now, the reason why the central bank are doing that is because to tackle the very high levels of inflation. Inflation in the US is running at a 40-year high. This is causing a lot of economic and also political strife. Because if people's bills are going up at a much faster rate than their wages are growing, which is the case, they're net worse off. Politicians don't like to have high levels of inflation because they want to get re-elected. And with that, we're seeing a move from the central bank to aggressively tackle inflation in the short term by hiking interest rates. But at the same time, that brings about the increased possibility of recession. We've already seen certain signs that the US economy is slowing down, and indeed the global economy. So increasing the cost of borrowing at a time when you're already on a downward growth trajectory actually just really compounds the issue. And that's why we're seeing aggressive moves to the downside in European stock markets.
Right, David, so we have to be ready for slower growth, for higher unemployment. But can I ask you, do we at least have reasons to believe that inflation will indeed be contained from now on? Will all these hikes and moves by the Fed, by the Bank of England, potentially by the ECB, be really effective?
I think to a certain extent, yes, but only in a very limited way. Keep in mind when the interest rate is being increased, that's done to actually as a way of intentionally increasing the cost of borrowing, which will chip away at demand. But a lot of the inflation that we're seeing at the moment is actually more to do with squeezed supply, such as particularly in the commodity spaces, be it agricultural commodities, wheat and whatnot, and also energy commodities such as oil and gas. So the sharp rise in inflation has probably got much more to do with an absence of excess supply than actually exceptionally high demand. So I think to a certain extent, if the Bank of England and the European Central Bank and the Fed all act in concert and actually hike interest rates, it will chip away at demand. That should at the very least level out inflation. But the problem for all those central bankers is that much of this inflation is actually out of their control. It's got to do with actually a squeezed commodity market rather than actually excessively high demand.
Interesting. David Madden, many thanks for being with us today.
Thank you.